Hello there, welcome to The Open on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Food retailer Metro beat revenue estimates in its latest quarter. Sales were up more than 3%. The Montreal-based grocery giant also posted profit that was ahead of expectations. However, the company noted that it is only now getting over problems at its frozen distribution center in Toronto. It resumed operations last week. It was a 2-month shutdown, which is expected to cost $15 to $20 million in the first quarter. Shares in Target down about 3% in the pre-market. The discount retailer trimmed its profit forecast for the full year as it deals with markdowns and soft demand in key merchandise areas. Third quarter results did surpass estimates. Same-store sales, though, were down by more than 2%. For the fourth quarter, Target is sticking with its expectation of a low single-digit decline in sales. Shares in TJX are up in the pre-market. This is the discounter that runs chains such as TJ Maxx and Marshalls and Winners in Canada. It beat estimates on sales and profit. The company also raised its guidance on same-store sales and boosted its earnings forecast for 2026. TJX Canada posted an 8% growth in sales. The company says the fourth quarter is off to a strong start. And U.S. futures holding their own. It's been a choppy few days, though, in the market with tech stocks well down from their highs. Let's have a look at how the TSX traded yesterday. Still up almost 21% in the past year. It slipped a little yesterday. And let's have a look at the oil first. Oil first, the world's biggest commodity. Let's see how it's trading. And you can see oil under pressure once again. Ukraine and Russia exchanging attacks. But the fears of oversupply in the oil market still weighing on crude. And let's have a look at gold. And gold holding its own today. There are mixed expectations on whether the Fed will cut interest rates again next month. Of course, the head of that central bank, Jerome Powell, has indicated that he's in no hurry to do so. Let's have a look at the Canadian dollar. It showed signs of strength yesterday, losing some ground this morning. And finally, Bitcoin. Bitcoin well down from its record highs and losing more altitude. Interesting. People have said part of that is the selling in tech stocks. Bitcoin sometimes moves in parallel to the tech sector. There's a big fat shoe due to drop after the market closes today, and that is the NVIDIA earnings report. Let's get more from Paul Harris, portfolio manager at Harris Douglas Asset Management. Paul, thanks very much indeed for joining us. Obviously, NVIDIA, widely watched, may provide an indicator as to whether this AI spending frenzy can continue. Just talk to us, though, about the weakness we've seen in stocks. You say, sure, they're down, but it hasn't been a dramatic sell-off.
Well, thanks for having me on, Andy. Yeah, I mean, I think that the issue for me is that, there was kind of this very bullish tone to the market, and it's nice to have these pullbacks. But, the Dow's down 3, the Nasdaq's down 4. So I think that that's just not enough. I think what you really need to see over the next little while, if you see a 10% pullback, the VIX getting up well above 30, I think that would be much more seen as a capitulation and the stocks moving from sort of weak hands to stronger hands. But until I think you see that, and I think part of the reason why the market is so choppy, as you mentioned earlier on, is the fact that, there's a lot of things that we don't know about. The employment picture is very difficult because we haven't had any employment numbers. And that was one of the reasons the Fed was so worried about it earlier earlier on in the year and they cut rates. We don't know about inflation numbers. We don't know about, I mean, I think the market is saying that the Fed is not going to drop rates in December. So, but, you know, what will they do in December? What are they going to be talking about is really important, I think. And so I think these things are all kind of leading to some uncertainty. And I think with that uncertainty, you're getting very choppy markets. But I think that you've seen a really kind of it's healthy in a bullish market to have pullbacks. I think that, you know, sort of I don't feel it's strong enough, but I mean, I think that, you know, if you feel like putting some money to work here, it's fine. But I would say that you could see you know, with these kind of uncertainties, a little bit a better pullback, and then I think that's a good opportunity to buy.
That's interesting. You be inclined to keep your powder dry. Maybe we could put up a 1-year chart for Meta, because that's come down quite a lot, partly on concerns about massive spending on AI.
Right. So I think the issue for Meta is because they're spending a lot. So Meta is unlike Meta is obviously an advertising company for all intents and purposes. They've got some great social media brands which people go to all the time, and so that's one of the things. I think the issue for Meta is that, you know, with all this spending, if you look at Microsoft or Google or even Amazon, they have this cloud business which they can actually defer. People rent from them, so they can generate a lot of revenue by people renting their cloud space, even though they're expanding. Whereas Meta can't do that because they don't have a cloud business, and so what they're spending to actually be able to get somewhere down the road, better advertising returns because they can use AI to effectively target people in a better way. They are doing that right now, but I think that the spend relative to what the revenue is on that, I think people are worried about. And I think that's the worry with Meta. It's come off because of that. You know, some positive things is that they were in court for their deals with Instagram and WhatsApp, and I think those things are all gone away. So that's a positive thing. That was overhanging the company a little bit, but I think that's a positive thing for them. I think they are seeing revenue growth from what they're spending, what they're doing, but I think the issue is that they're spending a lot, and like he did with the metaverse, people get worried that he spent a lot on that stuff, and then he sort of, I don't want to do this anymore, got religion, dropped all the cost structure. So I think they're worried that this may happen again. But I think if they want to be a player in AI, they need to spend the money to do that, right? And I think that it's a little bit more difficult for Meta than it is for the other players who are doing the other AI players we normally talk about.
The new CEO at Barrick, I'm not sure, I can't remember if Mark Hill is interim or not, but anyway, shaking things up. I didn't realize that Barrick was seen as having such a weak safety performance, but Hill says it's deeply concerning, the safety record. And it looks like Barrick is in a hurry to win back investor favor.
Well, I think two things you have to remember about something like a company like Barrick in that kind of strong gold environment. These kind of large cap stocks obviously don't do as well as mid-cap names in gold because they don't, people think of them very differently. You want to get the most leverage to the gold price, and a mid-cap stock will do that for you. So Barrick, and, even in a very hot oil market, you would notice that Suncor and C&Q would lack a smaller company, right? So I think that's what happens with a lot of these large cap stocks in a very bullish market for their commodity. That's one thing. And I think that's why people are, irritated that Barrick has not gone up a lot. But I think the issue for a lot of these companies is that they're not always in, great areas of the world. And so they tend to sometimes can look the other way on certain things. I think that happens a lot. And although it shouldn't, don't get me wrong, it shouldn't happen, but there's a tendency. So I think that's what they have to deal with, right? They have to make sure that they don't have a situation like BHP ended up in, where you had this massive problem with a mudslide and all these other things. So I think what they need to worry about is making sure that they do have proper safety and they are taking care of all these things, especially when you're in a business like mining, right, where it could have massive impact on a lot of people's lives, not only in the mine but also around them, right?
Yeah, it's interesting. Bloomberg argues that the stock, as we just saw, it's up about 120% in the past year, but Bloomberg argues that it has lagged the gold group, and with gold hitting record highs, people are looking for top performance, obviously.
Yeah, and like I said, I mean, I think in a up commodity market, people tend to buy mid cap or smaller cap stocks that have better leverage to the underlying commodity. And Barrick is a big, huge company with many things going on, so I think it's much harder for those companies in that kind of environment to do as well as the mid cap range, right?
We'd better go, Paul. Thank you very much indeed for joining us.
My pleasure. Anytime.
Paul Harris, portfolio manager at Harris Douglas Asset Management. Actually, I should say that Bloomberg says it's up about 120% in the past year, lagging peers, so they may be getting at other big cap goals. Coming up, both the U.S. House of Representatives and the Senate have voted in favor of passing a bill to force the Justice Department to release the files on Jeffrey Epstein. But what actually comes next? We'll have more on that story after this. U.S. lawmakers have voted in favor of passing a bill that would force the Justice Department to release its files on Jeffrey Epstein. The bill actually passed through the House of Representatives 427-1. The only no vote came from a Louisiana Republican called Clay Higgins. The Senate went on to pass the bill unanimously. The bill will now be sent to the President, Donald Trump. He reversed his position on the matter earlier and said he wasn't opposed to the release of these files. Let's get more from CTV's Scott Hurst.
Good morning, Andrew. The bill moved through both chambers of Congress remarkably fast, considering it had been stalled for many months as the White House and Republican leadership were ultimately working to quash it before it could get to a vote. And U.S. President Donald Trump has said that the Epstein files are ultimately a Democrat witch hunt. That's the latest we heard from the U.S. president. However, he said he will sign the bill as soon as it gets to his desk, and that could happen as early as today. In terms of what's on the schedule for the U.S. president, right now he is expected to speak later this afternoon or right around the noon hour at a U.S.-Saudi investment forum in Washington, D.C., so is expected to depart the White House around 11:30ish and then return after that speech. And both of those, Andrew, are open to the White House press pool, and we do know that U.S. President Donald Trump often does stop and take questions from reporters, so you can imagine that this will be top of mind for all the reporters there who are part of the White House press pool. But U.S. President Donald Trump has said he would sign this bill if it got to his desk. Now that we know that it did pass both chambers of Congress quite quickly yesterday, it is expected to get to his desk, Andrew, at some point today.
Of course, we've heard Trump called the Teflon Don. He apparently has been able to say pretty well anything and it doesn't damage him. Washington Post arguing that this is sticking to him, this issue of the Epstein tapes.
It has been an issue that hasn't gone away in terms of the U.S. president trying to quash any talk about Jeffrey Epstein or the release of these files. Of course, he was the one that was ultimately pushing for the release of these files in the run-up to the presidential election, which allowed him to return to the White House. But since he has once again become commander-in-chief, has not taken the steps to release all these files. How much ultimately could be redacted from these files, we're not sure. How much will actually be released, also not certain. And what exactly we will learn from these files, Andy, also not certain. The president has said in recent days he's advised to the attorney general to investigate Epstein's ties to prominent Democrats. As he has said many times, this is just a Democrat hoax. So that could all be tied up in what could be deemed ongoing investigations, and therefore some parts of the files might not, in fact, be released. So specifically, when the president signs the bill into law, that will technically start a 30-day countdown for when all the files should be released, Andrew. Yeah,
speaking of Democrats, you probably saw Larry Summers, the former Treasury Secretary. He's now stepping down from the board of OpenAI. After more emerged about his ties and emails exchanged with Epstein. So plenty of big names in America involved, even in remotely in this case. Scott, thank you very much indeed for joining us.
Thanks, Andrew.
Scott Hurst of CTV News. Up next, a bunch of high-profile websites, including X and ChatGPT, went down for many people yesterday due to problems affecting the internet infrastructure firm Cloudflare. We'll get more after the break. The internet infrastructure provider Cloudflare says it believes it has resolved a problem that led to outages on platforms including X, ChatGPT, and other internet features. Let's get more from Ali Ziai, professor of cloud computing technology at George Brown College. Professor, thanks very much for joining us.
Thank you so much. Thanks for having me.
Can you just remind us, what does a company like Cloudflare do? What is its business?
Sure. Cloudflare, Amazon, AWS, all these big, large corporations, these are the source and the home of internet. Basically, it shows that how reliant we are getting to these big companies. They are the providers of the services that we use every day. When we look at these companies, we see that how much dependency we have to these big ones. We are using their resources, their services day to day to provide to our customers to run our businesses. We use them for our business critical applications, all the way to productivity tools and services. Sometimes these outages will happen. It's not the matter of if, it's the matter of when. And the important factor is that how ready we are to face those challenges. When these outages happen, how ready our business is to quickly and gracefully switch to another solution and reduce the impact.
So we hear a lot about these hyperscalers, Amazon and Google, providing massive computing power for third parties. It sounds like Cloudflare is in the way of a traffic manager in between the user and the hyperscaler. Apparently, if I go to Cloudflare's equipment and it can deal with my equipment, my question quickly, it's cached, it'll do that. But then if it's a more complicated thing, it'll go to the so-called origin server?
Correct. So they're basically managing the traffic, not the entire internet traffic, but yes, they are one of the major traffic managers and traffic providers over the internet. And the recent outage, not to keep it too technical and keep it simple, was as a result of a glitch that they found on one of the network's environments, which started to spike the traffic and affected the network on some parts and started to grow. These ones will happen again. We don't know how often or what is the interval that these things might happen. But the fact that we see the effect on every other provider shows how dependent to them we are. And the important factor would be our preparedness to jump and react based on those activities.
You know, given the complexity of what millions of people do every day on the internet and the way we can download video instantly, it's pretty amazing things don't break down more often, I think.
Absolutely. No, I wouldn't say they are breaking that too many times. I wouldn't blame any of these outages on any of the providers. They all are providing unbeatable, unmatchable redundancy, resiliency, and scalability and features. No one with unlimited supply of money can build something similar to that in the amount of time that we have left. The technology is evolving so fast, and they are relying on these complex technologies. So these things will happen. Sometimes it's the architecture, sometimes the technology limitations, and sometimes an honest mistake of as simple as forgetting to renew a certificate every 10 years. So these things might happen. It's not a blame for any of these providers. We had 3 incidents of 3 large organizations in the span of 1 month, AWS, Amazon, and now Cloudflare. Well, we don't know. There might be another one coming next, but we need to be prepared for that. It's the complexity of the technology. Sorry, it's a little bit hot in here. It's the complexity of the technology that sometimes causes it, and sometimes the easy faults. There's no fault of any provider, I would say. And the fact that they are providing this level of service is unbelievable. I'm always amazed and explain to our students that how difficult it is to keep these lights running. Lights are something that we never notice. We see the light is on, we say, okay, it's on, but there is an army behind the scene to work 24/7 around the clock to keep these lights running. That's the same thing with these big companies.
Tell us, what is it like working with the computing engineers of the future? Obviously, AI is turning your industry upside down.
Absolutely. This is actually super enlightening for us. It is the highlight of my career that I'm working with the future engineers and the future architects or tomorrow's cloud engineers. That's why we mainly focus on educating them on these technologies and making sure that they are ready to design, implement, manage, and maintain an environment that is resilient enough, at the same time ready to withstand any other future disasters. Today, there is an issue, technical issue. There might be a disaster issue sometimes happening in one region, hopefully not, but we know that the Mother Nature sometimes is not the fairest one. So we teach them how to be ready, how to design a solution that can withstand the disasters. How do we decide to put which applications? Should we use one cloud provider? Should we use multiple cloud providers? Should we put it in one region, multiple regions across the globe? These are the things that we work with the students. And with the AI, as you mentioned, it is absolutely helping a lot. I believe that with the help of AI, we are expediting everything dramatically. Now, what was taking us several hours before, now it's a matter of a few minutes. And that's what the students actually are relying on. We're using it for automation. We're using it for automated monitoring and response. There is a lot that we can do, and there is a lot that still we don't know what else we can find. It's an evolving field, and AI is actually speeding it up.
And just give us an idea before we let you go. What the split between the sexes? Is it still mostly boys or young men in your class, or are you getting what percent would be young women? Can you give us a ballpark?
Sure, absolutely. I don't have the exact number.
No.
So at least here at GBC, we have approximately 60% of the students, 60 to 70% are male students.
In computing.
In computing, yes.
Yes, sorry.
But interestingly enough, I see in every semester, I see a growth in the field, and I see that more female students are actually being attracted to the field. So now it is very enlightening for us. It's very great to see that more female students are actually starting to come to the field of IT. And now it's not that same old environment that was mostly male-dominated before.
That's interesting.
It's starting to change, which is amazing.
Yeah, for sure. Yeah, because we need those women's skills. Thanks very much indeed,
Absolutely.
Professor. That was great. Thanks
Thank you
very much indeed.
Thanks for having me.
Joining us. Okay, we've got lots more on the show there, but we heard from Ali Ziai of George Brown College. Stick with us. We'll be checking out the markets and the futures and the opening bells. Here are the opening bells on Wall Street. At the NASDAQ, it's Big Brothers, Big Sisters of America, celebrating that mission's 120th anniversary. Okay, at New York, here's a company that really reflects the tenor of the times. AI Infrastructure Acquisition Corporation, celebrating its IPO. It's time for the first 50. And let's check in on the equity markets. We did get some strength in U.S. futures after a choppy few sessions. So you can see stocks now pointing up in early trading, and Canada, our benchmark index, up 1/3%. Some stocks that are on our radar. Metro, so the stock down slightly. It is complicated here whether they beat or not. Now, sure enough, the adjusted EPS was $1.13. The analysts were looking for $1.09. However, Desjardins says that consensus of $1.09 may have been understated, as some estimates included 10 cents of non-recurring costs from the shutdown of that gigantic frozen food distribution center. When we normalize for this, Desjardins says we estimate consensus will be closer to our estimates. So it was in line, the earnings were in line. Slightly soft grocery same-store sales growth, Desjardins says, at 1.6%. But there was continuing solid pharmacy gains, up almost 5% on the same-store sales basis. And there was a gross margin improvement as well. So the operations of that frozen food center resumed November 10th, and they hope to be back to normal by the end of December. And as we mentioned on the headlines, direct costs associated with this temporary shutdown will affect earnings by 15 to 20 million in the first quarter of 2026. So they are ramping up the freezer. Oh, wow, I'd love to see. They must have some gigantic freezers there for a shutdown to cause such problems. And let's have a look at Brookfield. Now, I think Brookfield Asset Management is the focus here. It's always complex with these guys. Brookfield Asset Management is targeting $10 billion US in fund commitments for a global artificial intelligence infrastructure program. And they've teamed up here with NVIDIA and the Kuwait Investment Authority. Now, we know that Brookfield is already investing and beating the drum on the potential of AI-focused data centers, but it looks like they're stepping it up. And already this, what are they calling this thing? It's basically Brookfield AI Infrastructure Fund. They've launched it. It's already received $5 billion US of capital commitments. Let's check out some stocks south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, thanks very much indeed. I don't know if you're a big renovation guy. I'm not. I hate that stuff, but I always find it so frustrating. But in any case, Lowe's posting stronger than expected profit.
Yeah, Lowe's is kind of offering a little bit of a bright spot in the retail earnings picture in the United States this week. As you remember, we've already seen Home Depot, and those results were pretty rough. Now Lowe's is out this morning, and it is the top performing stock in the S&P 500 so far this morning. It is up 3.7%. They saw same-store sales growth for the second consecutive quarter. They beat their third quarter earnings. They saw online growth, and they saw growth in sales to professionals. So those people that you and I hire to do the work when we get too frustrated, Andy, help build a little bit of momentum here. And as I said, we haven't seen that many bright spots within the retail earnings picture, including from their big competitor, Home Depot. But Lowe's this morning delivering on that.
Yeah, on the rare occasions when I manage to fix something around the house, it is very satisfying. But I always find I have the wrong tool, or that model, or they don't make that type of fixture anymore. Anyway, contractors, I admire what they do. Target is trimming the top end of its profit forecast.
Yeah, Target is off this morning, and at one point it was one of the top decliners in the S&P in the pre-market session. Worth watching over the course of the session here. So they had their third straight comparable sales decline, quarterly sales decline, pardon me, in the quarter. They're trimming, as you mentioned, they're trimming their outlook. We did hear from them earlier this earnings season with a bit of an outlook that they were going to cut costs, they were going to cut jobs, etc. But still, despite some of that pre-release information that we had from Target, the stock is still off today. This is still a miss from the company. And as I said, it's that third straight comparable sales drop on a quarterly basis, which is getting a little bit of attention from Wall Street and a little bit of negative attention. Well, the stock is actually technically up right now, but worth watching over the course of the session because it was down sharply pre-market.
Thank you very much, Jeff. We're going to stick with retail after the break. TJX, the big discount retailer, saw strong sales growth in Canada in its latest quarter. We'll look at the company's overall results when we come back. Lots of America's biggest retailers are reporting their results this week. We got numbers today from TJX. That's the discounter. It runs chains like TJ Maxx and Marshalls and Winners. It beat estimates on sales and profit, and the company is raising its forecast on same-store sales and profitability for 2026. Let's get more from Mary Ross Gilbert, Senior Retail Analyst at Bloomberg Intelligence. Thank you very much for joining us. We love talking retail with you. What jumped out for you with these TJX numbers, please?
Yeah, good morning, Andy. So what's really key here with TJX is the company does guide conservatively. So when you look at their raised guidance, what they really raised in terms of comp sales really reflected the gains that they had in the third quarter. So their comp sales rose 5%. It was led by Marmaxx, meaning the TJ Maxx and Marshalls chains. But also they saw strength in Canada. Canada was up 8%, and home goods too turned in a good figure they were also up 5%. So we're seeing strong gains, but that's the reason why they raised the full year guidance. For the fourth quarter, they're still guiding conservatively for a comp sales gain of 2 to 3%. We think they beat that. So we think that they're just being conservative as they always have, and they demonstrate superb execution. They have the assortment across that appeals to all income demographics and with the brands that these consumers want. So that can range from Steve Madden all the way up to Gucci and Balenciaga. So they have something that everybody wants, and it's the brands. And they're finding no shortage of product out there. So they actually made some incremental buys in the third quarter because they were able to get a good deal.
And there is that entertainment factor, isn't there? You go in and browse and you might find some high-end thing discounted.
Absolutely. Yeah, it's a treasure hunt. That's what it is. And that's why you're seeing a lot of strength there. And so it's sort of the opposite of what you're seeing at, Target. Target had weakness, and apparel was cited where they're still seeing declines there. And the reason for that is they're just not executing. Target had always been known for coming up with good styles and entering into collabs that sell out. So they need to really up their game there. But what it shows is that others are executing well. And of course, with TJX, they have a history of good execution. But you're also seeing other brands like Gap. The Gap will be reporting tomorrow after the close. And we think you're going to see strong results coming out of Old Navy. So that, again, appeals to the lower income or the consumer that is really seeking value.
Just looking, maybe we could pull up a 5-year chart for TJX. The stock is nearly at record highs. It hit a record last week. And over 5 years, TJX shares have given investors a return of 150%, including dividends. Walmart's not too shabby, but it's 114% over 5 years. So TJX, it's captured the zeitgeist, hasn't it? People are feeling the pinch. They want bargains.
Yep. Plus, they have international exposure, and they're the only one that actually has an e-commerce business in the off-price world.
Oh, that's interesting. They've pulled that together. That's interesting. We know that they're in Canada. What other countries are they in? Do you know offhand?
Yeah, no, they're across Europe. They entered Spain, and then they also have some joint ventures in the Middle East and also in South America. So, the company is constantly looking for opportunities, investing in off-price and offering their strategic expertise through those investments, and then also via their own business and their own, being their owned and operated in full international business. The comps were up 3% in the quarter. So you can see that around the globe, they're showing strength. The off-price model really works.
And of course, we know the margins in clothing are usually pretty fat. So it's logical to seek bargains, seek stuff that's marked 50% off.
Yeah, so on the margin side, they did beat on the margin side, and they did raise guidance on margins. Like I said, a lot of it had to do with the gains that they had in the third quarter. But also, I think, they've been able to manage tariffs, the impact from tariffs. They only directly import probably something less than 10% of the merchandise is something they directly source. So they've had a minimal impact on margins with the impact of tariffs.
And basically, they get clothes from other retailers that these retailers feel won't sell and just want to get it out of the store.
And from other brands, yes. So that's why you will see a whole host of brands. You'll see Karl Lagerfeld, Calvin Klein, and you'll see Tommy Hilfiger. I mean, you name the brand. You won't see a lot of Ralph Lauren, though. They've really, before they reset their strategy, they really cut sales to the off-price market. So you don't see a lot of that brand, but you do see a lot in luxury. Yeah, I sort of touched on that earlier. You'll see Versace, you'll see Chloe, Fendi.
I thought people like Fendi and Versace at all costs would try to keep stuff out of the discount channel, but it does leak through.
Yes, it does, absolutely. You're not going to see it with Louis Vuitton or Chanel, but you will see it for all those other brands that I just named, Ferragamo, you name it. You'll see it in handbags, shoes, jewelry, and other accessories.
Oh, that's interesting.
And even apparel. You'll find Moncler also at TJX, at TJ Maxx.
Some of the luxury brands, and it might be Vuitton and people out, traditionally I heard that they would burn stuff they couldn't sell. They were so anxious it didn't get into the discount world. I think they've come under criticism for that, but it's interesting, but it is entertaining. I got to admit, sometimes I go into Winners and just see, what's going on here, anything that might look good on me, but usually better to consult with my wife, I find. Anyway, we better leave it there, Mary Ross. Thanks very much. Mary Ross Gilbert, Senior Retail Analyst at Bloomberg Intelligence. Yesterday on Market Call, we were joined by Colin Shazinski, Chief Market Strategist at SIA Wealth Management. The topic, a technical analysis, and his top picks were Power Corporation, Alphabet, and General Motors. Today on the show, we have a newcomer to Market Call. He's been a guest many times, Tim Regan. He's Managing Director at King West, and Tim will be taking your questions on North American large caps. Up next, more on the battle over which fighter jets will be added to this country's military fleet. Sweden's royal family is lending its support to Saab's bid. They've got the monarchy on their side. We're going to have more after the break. As Swedish royalty landed in Canada, the dogfight over which fighter jets to add to this country's military fleet kicked into high gear. Executives from the Swedish manufacturer Saab came along for the state visit, making a sales pitch for their aircraft. Adding to rumors and speculation swirling about the Canadian Armed Forces potentially considering a purchase of the Swedish fighters. CTV's Geneviève Beauchemin traveled to Stockholm and took a closer look.
This one, it's a Gripen E.
On a tarmac in Sweden, Saab showed off the fighter jet it hopes Canada will buy.
So it's really state-of-the-art systems packed in here.
Part of the company's sales pitch is that the Gripen is perfectly suited to protect the Arctic.
What we designed the system for is actually to be able to withstand the extreme max in terms of cold, so minus 40, minus 45. We should be able to land on a road on a full packed with ice, be able to turn around in 10 minutes.
As the battle of the fighter jets revved up, Saab also suggested Gripens could be assembled on Canadian soil, creating, it says, 10,000 manufacturing and research jobs. But some Canadian contractors say a deal with Saab could also cost jobs. L3 Harris in Quebec is aiming to set up a maintenance hub for the F-35.
Here we're talking about preserving the jobs of 1,600 Canadians today, the creation of an additional 5,000 jobs for the F-35.
In 2023, Canada agreed to buy 16 stealth fighters built by U.S.-based Lockheed Martin, with an option to scale up to 88. But Ottawa is reviewing the deal in the middle of a trade war. Industry Minister Mélanie Joly said today Gripen's job offer is interesting.
I don't believe that we've had enough jobs created and industrial benefits done out of the F-35.
But Lockheed Martin says about 30 Canadian companies are currently involved in the F-35 supply chain, and that it expects to produce over $15.5 billion in industrial value for Canada, with projects since 2007 and spanning through 2058. Analysts say Canada faces a tough choice.
There's a lot of value to the F-35 contract, as the Armed Forces have said in the past. It is a fully integrated aircraft. It's the most advanced fighter that we have in the Western world. The question you have to ask yourself is that aircraft overkill for Canada?
This is how you refuel an aircraft.
Saab hopes an assembled in Canada Gripen will fly.
I mean, there's no secret. Canada has a very skilled workforce.
For Canada, it's a high-stakes decision, and the results will be measured in years to come. Geneviève Beauchemin, CTV News, Stockholm.
Coming up, Barrick is shaking up its leadership amid speculation about a possible breakup of the miner. Barrick is shaking up management to improve performance. Speculation swirls over a possible acquisition of the company or a breakup. Let's get more from Bloomberg North American Metals reporter Jacob Lawrence. Jacob, Barrick has an interim CEO and sounds like he's not hanging around. He wants changes at the company.
Yeah, that's right. So he announced really quite a dramatic sweep of changes yesterday across the company. In an email circulated to employees that we got a hold of yesterday afternoon, he's saying that several leaders will be departing and there will be new appointees. So Barrick's head of corporate development, a guy named Kevin Thompson, is out after a pretty long time at the company. And the firm is also seeing the departure of several leaders at its North American assets. So the COO of its North American assets, the CFO of its North American assets, they've both left, and there are new people who are coming in to replace them. There are several reasons for this, but one notable item that was highlighted in the letter was some of the safety concerns that we've seen at Barrick over the past year. There have been 3 fatalities across its operations. One of them has been at the North American assets, and Mark Hill, Barrick's interim CEO, called these concerns, he called this deeply concerning, and he wants to see a stop to some of the operational issues that they've been facing. And I think that seems to clearly be part of the reason for a lot of these changes that have come into place.
Yeah, it's interesting. 3 deaths, and actually Mark Hill was talking to Niall McGee of the Globe, sounding a similar note here, saying that, yeah, we got to do better. And when you improve safety, everything improves. It's interesting, okay, awareness, doing things step by step. And of course, a breakup of the company to try to woo investors, because there's long been worries, haven't there, over geographical risk. You and I were talking about this yesterday, especially in Africa.
Yeah, that's right. I mean, this is a big, complicated company with a sprawling portfolio. You know, they have gold mines in Nevada, they have a copper project in Pakistan, projects all across Asia, Latin America, Africa. And as a result, they've run into a lot of geographical issues over the past few years. The current issue that they're facing that has really sort of reached its apex at the company is the seizure of its Mali gold mine, which was taken by the government about a year ago now. And, you know, this is just sort of one of many problems, which is coming at a time when gold miners have been trying to consolidate their locations, like where their mines are. And, you know, we've seen companies like Agnico perform extraordinarily well, largely in part because their mines are all consolidated in Quebec or around North America. And so, you know, we've seen a pivot in the industry towards that. And I think that's something we're seeing with Barrick right now, where, you know, the new CEO is in, or an interim CEO is in, and is seeing what kind of changes he can make at the company. One of them is to try to sort of focus this firm on its North American assets.
Jacob, thanks very much indeed. Really appreciate it. Bloomberg's Jacob Lawrence. The Prime Minister has embarked on a week-long trip to the United Arab Emirates and South Africa on his latest trade-seeking mission. CTV's Rachel Aiello has more in this report.
Prime Minister Mark Carney is embarking on a nearly week-long trip to the United Arab Emirates and South Africa. And he's hoping to return with stronger diplomatic ties, as well as new trade and investment agreements. Visiting two of the world's largest emerging markets, Carney is hoping to attract capital to Canada to help build major infrastructure projects and fuel this country's energy, defense, and technology sectors. The Prime Minister's first stop will be in Abu Dhabi. There, he will meet with the President of the UAE. It will be the first visit from a Canadian Prime Minister since 1983, when Pierre Trudeau went and brought a then young Justin Trudeau with him. The Prime Minister will also meet with heads of major investment funds and deliver a keynote speech to a business crowd. Carney will then travel to Johannesburg on Friday. While there, Carney will meet with South African President Cyril Ramaphosa, and senior officials say they're hopeful the two countries can come away with an agreement to boost bilateral trade. But the main event will be the G20 Leader Summit taking place this weekend for the first time on the African continent. On the sidelines of the summit, Carney is set to hold a series of bilateral meetings. And while his office won't yet say which world leaders he may be sitting down with, we know U.S. President Donald Trump won't be one of them, as the Americans are boycotting the G20. Rachel Aiello, CTV News, Ottawa.
Up next, we're going to get perspective on where markets may be headed. We did see 4 straight sessions of losses for the American markets, but we have seen signs of strength today. Stick with us. Metro beat revenue estimates in its latest quarter, with sales growth up more than 3%. The Montreal-based grocery chain reported headline profit that topped expectations, but it was complicated by the costs of a breakdown at their gigantic frozen distribution centre in Toronto. That has resumed operations. It was a 2-month shutdown expected to cost up to $20 million in the first quarter of next year. Lindsay Biscaya will have more in a moment. Shares in Barrick Mining trading higher. The company is shaking up management after reports that Elliott Management has built a large stake in the miner. Bloomberg obtained a letter to employees signed by the interim CEO mentioning changes to the regional operating model of the Toronto-based company. 2 senior managers and a top executive are departing as part of the overhaul. We're watching shares in Brookfield Asset Management today. The company is teaming up with NVIDIA and the Kuwait Investment Authority to introduce a $100 billion US global AI infrastructure program and fund. The plan here is to make purchases in AI assets across energy, land, data, and the whole chain. The fund launches today with a target of $10 billion US of equity commitments. And here's a look at our beloved Toronto Composite. You can see it is edging up in early trading. Big traders right now, companies with a lot of dollar value changing hands. Manulife is up about 60 cents. Celestica is higher, more than $30. It has seen some selling. And Shopify is up almost $8. And let's have a look at the U.S. markets. They've had a rough go of it over the past week or so, but they too are seeing signs of strength. Right now, NVIDIA is up just over $4 as we await their numbers after the closing bell today. Alphabet is up around $15, and just on both classes of Alphabet shares, and Apple is ahead about $2. Investors didn't love the latest quarter and commentary from Home Depot, but Lowe's has been trading higher after profit in its latest quarter topped expectations, and same-store sales were positive for a second quarter in a row. TJX, as we already touched on, also doing well. That stock, TJX, trading near record highs. Let's bring in Denis Taillefer, Portfolio Manager at Caldwell Investment Management. Denis, always great to see you. Thanks for joining us. Talk to us about Lowe's. Is this a stock you'd be inclined to buy right now?
Well, it's funny you say that. We don't own it right now. We don't own Home Depot. We haven't been in that space for a while. But the risk reward is starting to look a lot more interesting for that space. The stocks have been under pressure for the last few months. They've come off quite a bit. We think there's still some headwinds ahead of them. Housing affordability. So the whole housing market in the U.S. seems to housing starts, especially for single-family homes, has been slowing down quite a bit. Consumer sentiment has been softening. So there's definitely some headwinds, and that's kind of shown into the stock priced in. But we also think that this basically just creates an opportunity here to really start looking at that sector, because again, the risk reward is starting to look much more appealing here than it has in over the last several months. So we're not there yet, but definitely doing some work to see if this is the right timing to take some exposure there.
It is a bet in part, obviously, on the U.S. housing market. Lower interest rates generally good for housing, obviously.
There's definitely more of a macro event that we kind of need to see happen to see these stocks kind of start to rally again. They will rally ahead of that, but to your point, right? You need probably lower interest rates. You need to see that housing market pick up again, and then as well, consumer confidence to really kind of start creeping up. So again, like we're saying, these are all kind of fairly depressed right now. You've got these stocks that are trading at what we think are fairly attractive multiples. They're very good businesses. Both Lowe's and Home Depot are great businesses, very well run. They dominate that home improvement market. So it's definitely they're definitely good businesses to invest in. And like I said, we're not there today, but we're definitely looking at the two names much closer.
Another name, TJX. It's been a favorite of investors because, of course, they offer off-price clothes, stuff they get from other retailers, and that stock near record highs. Would you be a buyer of TJX right now, Denis?
Well, we own TJX right now, so we have a pretty good position in it. We've always liked the business. It's such a good business model, and to your point, right? It's just they offer really good brands across the board at really good value, and it's everyday value, right? So they basically offer you brands at 20 to 60% discounts that what you would find in an apparel store, a branded store, right? So it's a very good value proposition. They appeal to just about every income demographic. They're gaining a lot of market share within the younger demographics as well, and they're winning market share. So if you look at this company, they've been a serial compounder. They're just basically growing quite a bit. It's mostly organic, and it's just because they're winning market share off of all of the other business models that are just not as strong a business model. So we've always really liked the business model, and TJX is really the best of breed within that space. And they delivered again today, just across the board. Just all of their metrics were just beat in every market, in every segment of their businesses. So they're delivering. It's a really good business model. We still own it. We have it in our momentum fund, and as long as it keeps delivering, we'll go along for the ride.
Metro reporting their numbers. They were plagued by the breakdown of that massive frozen distribution center. It's incredible the scale this thing must operate at. You would prefer Metro right now over Loblaw?
Yeah, if you look at Metro's always been considered kind of the best of breed, so it's always traded at a premium. Over the last few years, Loblaws has outperformed. I think Loblaws has been a little bit better positioned with its low price stores, right? So Metro's got a pretty good exposure there as well, but they are investing to open up more stores in that lower price point for groceries. We still think they're a quality company. They have a very strong bench, very strong management team. But today they're trading at a quite significant discount to Loblaws. So I think Loblaws deserves that premium because they have been performing better, delivering over the last couple of years. But I think the discount is just a little too too deep right now. So there's still some noise to go through Q1 with the issues they've had with this refrigeration system. So I think any kind of sell-off on the next few quarters is basically probably an opportunity to get into Metro or into that space at a much better price point. So I think the risk reward right now just favors Metro over Loblaws.
Well, let's put up a one-year chart for NVIDIA. It's obviously off its highs. It's so vast now. The company is almost become a kind of betting token on the future of AI. Would you be inclined to put money into NVIDIA right now?
If it comes off some more, it's definitely on our radar. We have exposure to the whole AI trade. We just don't have it through NVIDIA. I always feel like it's a crowded trade, so we try and look for opportunities that are not so crowded, where fund flows can kind of push those stocks higher. But we definitely pay very close attention to it. Obviously, their earnings are coming out tonight. We have a really good Q3 earnings season. It really sets up Q4 pretty well. The AI theme is still kind of the main driver of the market, so all eyes are on NVIDIA, and that will really help set the tone for how we're going into Q4. So while we don't own it, and I don't know if we will own it in the near future, we do have exposure to that overall trade, and we're paying very close attention because it will kind of set the tone going forward here.
What is your feeling on AI generally, Denis? Are you underweighting it because euphoria can push a group higher and higher?
It certainly can. So I'd say we're probably underweight the overall theme because it's such a big part of the index now in the S&P 500. But we still have a decent weight to the AI trade. Having said that, a lot of the companies we have, the valuations are fairly stretched, but they're the fundamentals are so incredibly strong. Their backlogs are growing. Their earnings year over year are growing at a much faster clip than the rest of the market. So from that perspective, we're fairly comfortable. But the valuations, we understand that any kind of hiccup in the story, there is valuation risk there. So we are paying very close attention. Like I said, tonight, NVIDIA's earnings report will be really help kind of drive how we'll see things going into Q4. So any kind of disappointment, we would expect to see a check back in most of these names. Because again, it's just the valuation risk there is still fairly elevated. So we're very conscious of that. And that's why we're underweight our overall exposure to AI, but we still have some exposure because we do think we're in early innings of that AI build out, and everything we've seen so far from the capital spending is still increasing year over year. So we're fairly comfortable with the companies we own and their earnings profiles.
Thanks very much, Denis. Great hearing from you.
Thank you, Andy.
Denis Taillefer is a portfolio manager at Caldwell Investment Management. Coming up, we're going to have more on Metro's results. Analysts are changing their target price on the company. We'll keep you in suspense as to what they're saying. Let's get more on these numbers from Metro, one of Canada's giant grocers, just reported its fiscal fourth quarter earnings. Looks like the profit was largely in line with analyst estimates. We're joined by our own Lindsay Biscaya. Lindsay.
Yeah, largely in line with estimates for Metro for the fourth quarter, but some sections did take a bit of a hit, specifically when it comes to same-store sales for groceries, like the food section of Metro. That took a hit because of some disruptions at a distribution center, the frozen food distribution center, which caused operations to kind of shut down there for 2 months. So Metro's still seeing a hit when it comes to some of their sales, and we'll talk more about that in a moment. But when we're talking about some of these earnings, net earnings fell to $217 million in the fourth quarter. That's compared to $219 million in the quarter last year. Sales grew by 3.4% in the quarter, so not bad. But what's interesting is most of that growth is actually coming from some of the discount and pharmacy retail networks. So pharmacies, prescriptions, that's really helping Metro to boost those sales and grow profits rather than revenue from food. Food same-store sales, as I mentioned, took a bit of a hit, only growing by 1.6%. Pharmacy same-store sales grew by 4.8%. And I mentioned prescription revenues alone, 5.5% growth for prescription sales. So that is really where Metro, and I'm sure some other grocery stores too, are really starting to make a lot of their earnings is coming from the pharmacy side of things rather than the food distribution side, particularly frozen food for Metro because of that distribution center.
Update us on the problem at the frozen center.
Right. So as I mentioned, operations were halted for about 2 months. They have resumed. Yeah, it did cause a bit of a disruption. Operations did resume on November 10th, not fully, though, and Metro says it's expecting a full resumption of operations by the end of this year, so by the end of December. But previously, it's now known that the shutdown is going to cost Metro about $22.5 million after taxes in that fourth quarter, and that's all because of lost food products and repairs, and then the cost related to rental equipment, because Metro had to rent quite a bit of like freezers and other equipment to keep that frozen food frozen so it didn't go bad. Those costs will impact net earnings by $15 to $20 million. So there's an earnings call happening right now. It started at 9 a.m. It seems as though a lot of those questions are going to be directed towards that frozen distribution center and how much of a hit Metro is going to take even moving forward after that. So we'll have to wait and see what they say.
I was buying cheese yesterday in a store called Maselli's, and a traditional Italian grocery store on Danforth. I'm not a big foodie, but they have stuff you can't get elsewhere. And they were talking in Italian. I said to a woman working there, I could listen to that Italian all day. And she said, yeah, they're being nice to each other today. So some days I think maybe a bit of shouting.
Some days maybe a little bit of shouting can be stressful in that industry, right?
Oh,
so
yeah, it's a tough industry.
Yeah.
Thanks very much, Lindsay. Lindsay Biscaya. Okay, let's have a look at some analyst reaction. It looks like these numbers not changing analyst viewpoint too much. RBC's Irene Nattel sticking at a hold on the stock. Price target unchanged at 112. Scotiabank's John Zamparo, sticking with a buy. He's sticking with the price target of 108. And Desjardins, Chris Lee, is sticking at a hold and his target unchanged at $105. After the break, we'll be joined by the author of a new book on the financial implications, the financial planning implications of moving from Canada to the US and vice versa. We'll be right back. Moving from one country to another is stressful. Let's zero in on the financial implications for somebody who's moving from the United States to Canada, maybe a Canadian who's moving back to the homeland. Our guest is the author of a book that highlights some of the tax and personal finance implications. We're joined by Sonia Dolgina, who is the co-author of Your Move to Canada. Fascinating topic, and thanks very much, Sonia. Start off with just a regular American who wants to, flee Trump, whatever reason they have for moving to Canada. What are the big implications for somebody like that in personal finance terms?
Yeah, thank you so much for having me on this show, Andrew. So in Your Move to Canada, we do cover both Americans moving to Canada and also repatriating Canadians. And really the main thing that we want to hone in on and focus is planning that needs to be done ahead of time. And that means planning for your investments, planning for your various retirement accounts. So a lot of the main things that individuals need to know is, the current financial institution that they hold their investments in the US might not be able to service them any longer for regulatory purposes. A lot of US advisors, US financial institutions aren't regulatorily able to service Canadian residents. So a lot of people who are moving from US to Canada are in a position where they feel stuck and, what do I do with my investments? What do I do with my retirement accounts? Do I have to sell everything? Do I have to cash it out? So what this book, Your Move to Canada, does is it covers a lot of the personal finance and tax implications and things and knowing what you need to do. For example, your U.S. retirement accounts, things like 401ks, traditional IRAs, you have a few options. Some Americans and repatriating Canadians think, oh, maybe I should just cash it all out. Well, of course, that could come with a very big, heavy tax hit, 30, 40%, and plus penalties if you're under 59 and a half. So, other options are rolling it into a traditional IRA. there are advisors in Canada who are actually licensed to manage U.S. retirement accounts, so that could get over the regulatory hurdles. So those are some of the things that we go over. We also go over capital gains planning. A lot of individuals say, oh, you know, Canada has really high tax rates. Maybe I need to sell all of my stocks and mutual funds. But of course, that can also come with a significant tax hit. So that is something that the book also covers, is the implications of moving to Canada. You actually get a step up in cost basis for capital gains purposes, which means that you don't necessarily have to pay tax in Canada on gains that accrued while you were in the US. So that is some of the things that the book covers, is what do you do with all of your investments? What are some tax smart financial strategies?
The Americans, though, if you're a U.S. citizen or green card holder, though, you still get taxed by the IRS?
Exactly. So as a U.S. citizen or green card holder, you are still subject to U.S. tax regardless of where you live. So most other countries in the world only tax you based on your residential ties, but the U.S. will tax you based on your citizenship or green card status. So that means that a lot of things that you may do in Canada, such as investing in a TFSA, which completely makes sense for a Canadian resident, or buying Canadian mutual funds or ETFs, could actually have quite negative tax consequences if you're a U.S. citizen or green card holder living in Canada. So you do have to tread lightly with those matters.
Give us a couple of guidelines for people, a Canadian moving to America. I know your focus is people going the other direction, but what should Canadians thinking of moving to LA for the weather, and what should they bear in mind?
Well, that's a really good point, actually, LA. So what you need to consider is, how is the tax treaty going to help you, or is it even available to you if you're going to be moving down to the U.S.? For example, if you have Canadian retirement accounts like RRSPs, those can continue to be tax deferred in both Canada and U.S. federally, but certain states like California don't recognize the tax treaty, and they can actually tax dividends, interest, investments, capital gains for state tax purposes. But otherwise, the really big one when it comes to moving from Canada to the U.S., or just to Canada, anywhere else really, is departure tax, deemed disposition. If someone has assets that have appreciated in value in non-registered accounts, you could be deemed to have sold those at fair market value, and there could be a substantial capital gains as a result. And also, you need to consider that for U.S. purposes, how are they going to tax those gains if you actually sell those stocks in the future? So the book does indeed cover what could happen if you move from Canada to the U.S. and some treaty elections that are available to ensure you're not double taxed.
Just a final guideline. You obviously should get professional help for dealing with this stuff.
Yeah, exactly. And that's what we discuss as well, is sometimes individuals, you know, maybe they'll work with their Canadian accountant who isn't really, doesn't know much about U.S. issues, and vice versa. They'll work with a U.S. accountant who isn't versed in Canadian issues. But what you could do is work with a cross-border tax accountant. So in Canada, of course, we have lots of folks who are American. So there are quite a few cross-border accountants who do have that specialized expertise in both Canadian and U.S. tax matters. So that's what I would highly suggest, especially in your year of move or planning ahead of a move between either country. Work with a cross-border accountant who is well-versed in both Canadian and U.S. tax rules.
Sonia, thank you very much indeed.
Thank you so much for having me, and you could find Your Move to Canada on Amazon.
Good,
thank you so much.
Good stuff. Sonia Dolgina, co-author of Your Move to Canada. Coming up, Lowe's topping expectations in its latest quarter, boosted by consumer spending on home renovations. Metro beat revenue estimates in its latest quarter. Sales were up more than 3%. Profit at least in line with expectations. The frozen distribution centre in Toronto resumed operations last week after a breakdown that resulted in a 2-month shutdown, and that will cost up to $20 million in the first quarter of next year. Shares in Barrick Mining trading higher. The company is shaking up management after reports that Elliott Management has built a large stake in the miner. And Bloomberg got hold of a letter to employees signed by the interim CEO mentioning changes to the regional operating model of the company. 2 senior managers and a top executive are departing. Shares in Target edging lower. The discounter trimmed its profit forecast for the full year as it deals with markdowns and soft demand in key merchandise areas. Q3 results did top estimates, but same-store sales were down by more than 2%. And a look at the North American markets. After a few lackluster sessions, we are getting some gains in stocks today. The Nasdaq rallying almost 2%. Big traders in Toronto. Manulife up about 30 cents. Tourmaline ahead about 24 cents. And Celestica, which has lost a lot of ground, is up more than $30 this morning. And let's check out the U.S. We have the U.S. markets there, sorry. Big value traders right now. NVIDIA ahead about 6%. Tesla ahead about 9%. And Alphabet up, $9. I should have said $6 and $9. And Alphabet up about $19, leading the Mag 7 stocks higher. Let's check out some of those movers south of the border. We're joined by Bloomberg's breaking news editor, Laura Sanley. Laura, just remind us what's going on with Lowe's, please.
Lowe's is really standing out in what has been a tough retail week. They posted a profit beat. Their same-store sales grew for the second consecutive quarter. And this is a very sharp deviation from what we were seeing. Just a couple moments ago, you were talking about Target, and Target experienced softer demand. We had Home Depot report earnings a while back, and they also said that they're struggling a little bit more. But what really sets Lowe's apart is that they've been focusing on the professional contractor and that they've been excelling in areas like appliances, paint, kitchen products, and they're seeing growth in all of these areas among this particular clientele. Another thing they're also seeing is stronger online sales. They have a new AI assistant that is really helping its investments in e-commerce. So we're seeing this contrast with all of these other companies that we just mentioned, and analysts are pointing out that the company is well positioned for a rebound whenever the housing market may finally turn. So we're seeing a little bit of a strength and a bit of a bright spot here in what has been a bit of a mixed week.
Laura, you have a great story today that an AI music company called Suno has raised $250 million US. Menlo Ventures is a big participant here, and it's involved with tools for professionals and casual music creators.
I'm surprised you saw that story. Yeah, it's been a company.
Sorry, our producer Ryan Miller doesn't miss much. Carry on, Laura. Sorry.
But yeah, it's very interesting to see how much AI is getting involved in all of these other spaces, like music particularly. We have a lot of big players here. I believe one of them was NVIDIA, if I recall correctly. And so we're seeing this big valuation when it comes to AI. I believe this company was valued with a Series C round at, I want to say, $254 billion. So this is something everyone is really paying attention to and really signaling just how big AI has gotten and how big it's reaching when it comes to these investments.
It's causing concern in the music industry, as you probably know. Rolling Stone reports that there's a new album out. It's a protest album called Is This What We Want? And it's partly because of concerns that AI is just exploiting musicians' creativity. And Paul McCartney apparently contributed a silent track to it. So there are concerns, I think, about that musicians are not being paid or remunerated when AI makes use of their work.
For sure. I have some friends who are actually music journalists, and they've covered this, and this is something that comes up in a lot of conversation and something that's really impacting the cultural moment. I know streaming is also something that's very heavily involved right now. So AI is really bringing up all of these questions about the role of art, the role in technology in art, and what sort of fine line or balance we can toe between the two.
Yeah, the McCartney track, it's 2 minutes and 45 seconds of silence on this album. Laura, thank you very much indeed. Yeah. Laura Stanley of Bloomberg. Coming up, Hot Picks, we're going to look at 3 plays in utilities. Now it's time for Hot Picks. At one time, electric utilities were seen as a sleepy investment category, slow growth in the dividend, for example. But now, of course, they're red hot with the soaring demand for power to run AI data centers. Our guest has Eversource Energy as a top pick. It's a provider of electricity and gas service, and he reckons it's trading at a discount. Our guest on Hot Picks, Daniel Rich, Senior Equity Research Analyst at CFRA. Daniel, thanks very much indeed for joining us. Tell us about Eversource. What's distinctive about them, please?
Yes, and good morning. Thank you for having me here. So it's a timely question because, as you may see here, Eversource Energy actually picked up a bit of bad news this morning that I can explain. So Eversource is an electric utility based primarily in the New England region, so Massachusetts, New Hampshire, and Connecticut. And they've had some regulatory troubles in recent years in terms of local regulation that has put the stock at a discounted valuation relative to peers. Now, we are very bullish on the name because of the discount. We think that the growth potential in terms of earnings per share growth and capital expenditure opportunities in the region, as well as dividend growth, are pretty competitive with the peer group and meriting a better valuation. Now, this morning, the stock is trading down a significant amount because the Connecticut Utility Board basically denied Eversource's ability to liquidate or divest its water utility in the state. It's a minor business, 2% of the revenues in 2024. And why we think the stock is down is primarily because of what it says about the regulatory environment in Connecticut. Not necessarily that the water business is so significant, but if regulation is tightening, that is going to put pressure on shares. Now, again, going into this morning, we held a strong buy opinion, and we saw, like I said, the growth potential in terms of their rate-based growth, their ability to grow their asset base. We're expecting around 8% annually over the long term, which is quite competitive with the peer group. And the dividend yield is 4.3%. Up until now, it's probably even higher with this news. So we will need to rethink our decision here based on this news. But again, I think it's primarily potentially an overreaction, really, based on regulatory concern and not so much a financial difficulty, whether or not they can divest the water utility.
And sorry, you may have touched on this, where is their core customer base, Eversource?
New England, so primarily Massachusetts, but also somewhat in New Hampshire and Connecticut. And like I said, Connecticut's sort of the thorn in their side right now in terms of local utility pushback, regulation pushback. So again, we saw shares trading over 20% discount to the peer median before this morning. Now we're probably looking at 25 to 30%. And this is a stock that historically has traded around 16 or 17 times forward earnings. And now we're looking at a stock that's probably south of 13 or even 12 times earnings. So again, unless the company comes out with some significant guidance change after today's decision, which I don't expect, we do think that there is considerable upside potential here for long-term investors in Eversource.
Your next idea, a huge player, Duke Energy. What attracts you there?
Right. So Duke Energy, this is one of the largest electric utilities in the United States, long-term, sort of traditionally run name, and they are primarily based in the Southeast, so North and South Carolina, Florida, as well as the Midwest. They have operations in, for example, Ohio and Indiana. So Duke Energy is one of the names that we think is leading the way in terms of the infrastructure build out for data centers and artificial intelligence that's going to be needed in this country. Their capital expenditure plan was recently increased from $87 billion to what we think is going to be $95 billion from 2026 to 2030. which is significant in terms of the electric transmission distribution, natural gas distribution, and new electric generation capacity in terms of gas, but also renewables to power all of this electricity demand that we're seeing. So they're projecting what we think is a pretty attractive pace of electricity sales growth in their service territory. Next year, somewhere between 1.5% and 2%, and then an acceleration of electric sales, 3% to 4% growth from 2027 through 2029, which is well beyond historical norms. And we think also customer growth in their territories, particularly in the Carolinas as well as Florida, is very healthy. It's also supporting their ability to, at the regulatory level, get all of this capital spending approved. And we do think it supports a potential earnings acceleration towards the end of this decade. For right now, Duke tends to grow their earnings about 6 to 7% annually in terms of earnings per share. What we're expecting is towards the end of the decade, think maybe 2028, 29, an acceleration maybe to the 7 or even 8%, which would put it at what we think is a higher echelon, a more competitive valuation relative to peers. The shares do yield 3.6% of dividend currently. And like I said, the data center trend, especially in North Carolina, is attractive. Amazon Web Services had a $10 billion investment that they announced recently going to support Duke Energy.
We'd better keep it moving. I'm sorry, you've only a minute left for your last idea. Sorry about that. Sempra Energy, what attracts you to this stock?
Right. So Sempra, this is a company that is primarily based in California and Texas, two very attractive markets, especially the Texas market, which is probably one of the fastest growing in terms of electricity demand and data center growth. This is a name that we think, after a lot of divestitures of non-regulated businesses in Mexico, for example, and a lot of their liquefied natural gas terminals in Central America, they're expected to see their earnings sort of bottom this year and then accelerate in the future. They're having an attractive 7 to 9% growth target in terms of earnings per share. We think they can reach the top end of that potentially. And like I said, because of their divestitures of non-regulated businesses, the earnings mix of their regulated operations is probably going to be close to 100% as opposed to about 80% today. So we think it's a less risky play, and the valuation should benefit as a result.
Daniel, thank you very much indeed. Daniel Rich, Senior Equity Analyst at CFRA. Coming up, we're going to hear how AI is changing the world of stock exchanges. We'll get the viewpoint of the CEO of the London Stock Exchange. The head of the London Stock Exchange Group says the initial public offering pipeline looks healthy, and he says there are highlights or there are opportunities in embedding artificial intelligence into workflows. He spoke exclusively with Haslinda Amin of Bloomberg on the sidelines of the Bloomberg New Economy Forum.
I think we're seeing some volatility. We're seeing some uncertainty. Uncertainty is probably the big theme. And if you look across markets around the world, there are questions about the levels of debt. There are questions about inflation. There are questions about AI. Is it a bubble? Is it not a bubble? I think that this kind of environment where there are that level of uncertainty, we see a lot of activity in the markets.
You welcome the correction?
Well, I'm not sure we're in a correction yet. I think there's always a healthy dynamic in the markets when investors take a step back and they look at what they're doing. I think there's been a lot of discussion on valuations getting stretched, a lot of discussion on whether some of the different sectors in the market, AI or others, will generate value or create some value destruction. I think it's healthy for people to be thinking about that and helpful. That's what makes a market.
Is there froth? What are you thinking about those stretch valuations? Are they justified?
I think what we'll see is that you're going to have some companies that will end up doing well, and you'll have some companies that will not. I mean, it's and when we see these kinds of frothy valuations going into new sectors or new innovation, sometimes it ends up well, sometimes there's real value destruction. I think it'll be a mixed bag.
But there's a lot of talk about how there's too much risk, too much leverage, and perhaps it is time to reassess, how money is deployed, especially with retail investors pumping in the money right there. Is there a sense that perhaps investors are underpricing the risk right now?
I think there is a case to be made that markets are underpricing a lot of the risks that are going on right now. And then that kind of underpricing, if you will, is supported by plentiful liquidity in the markets that we have seen really over the last 5-10 years. A lot of that pumped into the markets with government action. So it's hard to know. There's also a positive case to be made in a number of areas. Are valuations stretched, or are we on the cusp of a massive new productivity boom? I think it's going to end up being a little bit of each, but it's hard to know.
We know that that's not the only concern. The other concern is also to do with the private credit space in particular. The likes of Jamie Dimon have called out how cockroaches have appeared, and they have. Is that an area to be concerned about, or is there an overblown kind of fear that we're seeing at this time?
I think it is just another dynamic in the market. And when you have, whether it's private credit or private equity, I think the fundamental issue or the fundamental driver of uncertainty is that by definition, there's a lack of transparency. And transparency is helpful in terms of having sort of a public markets. You can have a daily mark to market. Sometimes those valuations in the public markets can get a little bit out of whack as well. So that's not a cure-all. But that kind of daily transparency is helpful in terms of reducing some of the uncertainty. When you have this significant expansion in private credit, a little bit of the blockage in the private equity markets, that adds to, it's another risk in the market. It's another risk in the system.
We talk about liquidity, a lot of money sloshing around, and that's supporting the valuations that we're seeing right now. But we're not really seeing that flowing to you, to the UK, the like of IPOs. How do you explain that?
Well, I wouldn't say it's specifically a UK thing. In other words, if you look on a global basis, we have had a slower period with respect to IPOs over the last few years. IPO market windows open and close. It was a pretty tightly closed window in a lot of markets for a couple of years. The US saw its market opening earlier this year. The UK has seen its IPO market open really since the beginning of October. We've had 7 IPOs in the last 7 weeks, and the pipeline's looking good. So I think that market, the IPO window will continue to open and shut depending on what's going on.
So do you expect the pace to accelerate? Because, I mean, you said that it is a global trend. It's not really. If you take a look at the IPO market in India, it's thriving. The IPO market in Hong Kong is thriving. But it's not where you are.
It's thriving now. But a few months ago, or last year, China was seen as uninvestable. And so these are cyclical dynamics. I think in the UK, you have seen the IPO market pick up really in the last couple months, and the pipeline's looking very healthy.
What might pull back, the interest from companies wanting to IPO from Asia, from the US?
Specifically into the UK?
Yes.
I think that the UK, one of the great strengths of the London Stock Exchange and the UK market is it's the most international financial center and the most international capital market in the world, significantly more so than the US, which frankly is more focused on US stories. Hong Kong tends to be more of a gateway for China and have companies having a China nexus. But the UK...
But it's global competition, David. I mean, like every single market, no matter what region, is trying to draw the IPOs to their market.
Sure, but the different markets have different strengths, and one of the great strengths of the UK is that international positioning, and that we have investors and companies in London from all over the world. Something like 40% of capital invested in London-listed companies comes from the US. We have capital coming from Europe. We have capital coming from the Middle East and Asia. Whereas in other markets around the world, it tends to be much more regionally concentrated capital.
Is the weakness in the UK economy a consideration for companies wanting to IPO?
I think whenever companies are thinking about IPOing, they're looking at the macroeconomic factors. If they have exposure to a particular country or to a particular region, Of course, they prefer to IPO in an environment that is looking like it has a strong growth trajectory ahead. And equities, by definition, are forward-looking. So I think a strong, healthy economy is helpful for companies that are looking to list.
Could the budget that's coming be a game changer in terms of sentiment towards IPOing in the UK?
I think there's obviously been a lot of focus and anticipation around what the budget will hold for the UK. I think the important thing for the UK from an economic perspective is to make sure that its fiscal house is in order, to have the breathing room for investment, both public sector and private sector investment. I think there are clearly some fiscal challenges. There's some political challenges. And I hope that the government can put a budget in place that addresses those kinds of needs.
AI, of course, is a big theme for exchanges. You know, AI, data. How do you see that contributing to the business?
So for our business, AI is a big opportunity for us. So roughly 50% of our business comes from our data and analytics. And we are seeing significant opportunities in terms of both embedding AI in our workflow, but also in providing our data into a lot of these large language models and cloud providers that are enabling more and more of this AI functionality. So that's a very significant opportunity for us. We're also using it in our internal operations, whether that's customer service, whether it's how we ingest data and use more AI and automation to do that. So big opportunity for us that we're seeing really across the business.
Let's have a look at the markets before we go. We'll start off with the TSX. It is higher in early trading. Let's have a look at the U.S. stocks. They did move higher this morning as well. The Dow slipping, but the biggies, the Nasdaq and the S&P 500 higher. ATZ in Toronto, maybe we could look at a 5-year chart. Aritzia, that stock, I'm almost sure, is hitting a record high right now. Sure enough, ATZ hitting a new all-time high. Investors buying into that story as it apparently grows relentlessly south of the border, striking a chord with U.S. women clothing shoppers. GWO, let's have a look at Great West Life. Doesn't get much more boring, but nice. Well, the life insurance industry, actually nothing against them. It's an amazing tool for financial planning in many cases. That stock, I believe, is near or at record highs. Yeah, sure enough, Great West Life moving higher in trading today. So we are seeing some record highs in Toronto. Our market is still a little bit down from its record highs. Another stock that's hitting a multi-year high right now, Barrick, ABX. Let's have a quick look at a 5-year chart for Barrick. It has outperformed some of the big miners over the past few years, but notably Agnico Eagle, but investors buying into what seems to be a dramatic restructuring story at that company. Another company of interest here, Stingray Group, RAY.A. They just announced a big acquisition in the music business. And Stingray just got the price to RAY.A. I'm not sure we can show that stock, but investors buying into that ubiquitous music provider. Thanks very much for watching the Open Morning Markets. It's coming your way.